Welcome to episode 9 of the Cash Flow Connections podcast. The topic for today is building a diverse portfolio. Virtually every financial planner on the planet agrees that diversification is critical for protection of capital, but both the guest and I believe that true diversification requires doing a little bit more than simply investing in several different types of stocks. In fact, there are many different elements of diversification, even within real estate, including the passive versus active question, amortized versus non-amortized investments, as well as the many different asset classes within the real estate sector. And then there's also other aspects of diversification, like planning for principal balances to come due over a diverse set of time horizons. So, if you're in the process of creating, growing, or protecting your investment portfolio, this is definitely going to add a few tidbits to your perspective on the topic. Now, before we get started, I wanted to mention we just finished our new ebook. This is a self-storage ebook that kind of goes into the details of the benefits of the asset class. It talks about why it's a great idea to look at self-storage given the current state of the economy. It talks about some of the value-add components of self-storage, which there are many, and also how to determine the profitability of a particular self-storage investment. So if you're interested in learning more about self-storage, here's what you got to do. Go to iTunes, find us on iTunes at Cashflow Connections Real Estate Podcast. Give us an honest rating, whatever you think is appropriate, screenshot the rating, send me an email with the screenshot at hunterthompson@cashflowconnections.com. Once you do that, I will shoot you a free copy of this ebook. I guarantee you're going to learn something. It goes into a lot of details about some of the intricacies of this asset class, which are very, very unknown. It hasn't had almost any exposure in the crowdfunding space. All right, without further ado, let's go ahead and get straight to the interview. How's it going, everyone? Today, our guest is David Coe. Dave is a real estate investor and advisor representing both homeowners and investors with the Coe Real Estate team, which is based in El Segundo and specializes in the South Bay area of Los Angeles. As an advisor, Dave caters to both active and passive real estate investors because tenants aren't for everyone. But Dave doesn't just talk about investing, he is an active investor himself. He leads a team that is doing ultra-luxury redevelopment in the Hollywood Hills and also runs a fund that buys non-performing real estate notes. Dave also founded the South Bay chapter of For Investors by Investors, which is a real estate investment club that is 100% focused on education and networking with absolutely zero sales pitch allowed. His experience as a realtor and advisor has produced a serious arsenal of resources for sophisticated homeowners and investors. So an awesome background in the business. Dave, it's a really pleasure to have you on.
Hunter, thank you for having me.
So before we jump into the details of this episode, which is going to be about building a diversified portfolio, let's talk about a little bit of background about yourself. Tell us a little bit more about how you got started in investing and a little bit more about your background.
Thank you. I will. My wife and I were both working for marketing firms and were in search of freedom and decided to get into real estate. So we started fixing and flipping homes about 10 years ago and learned a lot of lessons through that process. After that, I really got focused on dealing with self-directed IRAs and how to invest in real estate using that type of funding to do it. And that's really where I started kind of picking on the idea of diversification, which I know we're going to talk about today. I am a realtor here in California based in the South Bay, and because of the investment club, the For Investors by Investors, I do work with a lot of investors as well as with a lot of individual homeowners as well. One of the things that we specialize in is helping people fix up their homes before they sell them, but we just bring in the renovation funds. They keep most of the upside on the deal. So the background I had, I've done some development. We run a note fund together. We spend, a lot of time dealing with different kinds of real estate investments. And I think that's, when you think about diversification, there's so many ways to diversify a portfolio. And sometimes the issue of diversifying your time is just as important as diversifying your money.
Definitely. And there's just a ton of different examples of how to diversify. Definitely time is definitely one of them. So virtually every investment advisor, financial planner, CPA, whatever, this is always the consensus that it's a good idea to be diversified. But I have a feeling that what you think is diversified, truly diversified, is very different than theirs. So when you try to achieve portfolio diversification, what are some of the aspects that you really look for when building a portfolio or building a life if you're including time as well?
Yeah, and I think that last question is the important part, right? Before you build diversity in your portfolio, you've got to build it in your life, right? Real estate can consume a lot of time. And that's a more important, to me, starting point before you start talking about the money is you have to have an idea of how much time you have and you're going to put into this. So to me, that's a key area of self-inflection before you start building a portfolio. Starting to realize what your, the things that are most important to you are. And then from a diversification, how Wall Street talks about it, they're not wrong. I just don't think they diversify enough. You're still pretty siloed if you're just in stocks and bonds and things that are publicly traded. That's one of the things about real diversification is that it starts to diversify you in other aspects of the market.
Right. So that's definitely a good point, especially, the correlation between all these publicly traded items. It's so strong that you're not really truly diversified if no matter what happens, if Apple stock is going down, generally McDonald's stock is going down. It may not be as significant, but you're really completely tied to one another. So before we jump yeah, go ahead.
And I'm sorry, Hunter, and I also say the same thing happens in real estate, right? Like if all you're in is real estate, then you have that same risk. So within a vertical like that, there's ways to diversify within that. But to me, when we talk about diversification, I like to talk about a wider range of things that you can diversify in.
Okay, cool. So before we get into the details, I kind of want to get a big picture perspective on you for the framework in which this conversation kind of takes place. When you look at some of the richest people in the world, usually, from my perspective, they didn't really diversify. They were hyper-focused. What are your thoughts on the balance between diversification and focus as an individual and from a business perspective?
Yeah, and I really like that question. To me, when I think about, and you're right, if you think about some of the wealthiest people, they did build their wealth by being hyper-focused. And I think that's right. To me, I look at diversification as more of a tool for preserving wealth, right? Like once you've built it and you need to protect it and you want to preserve it, you want to pass it on to generations. To me, that's where diversification takes on a much bigger meaning.
Got it. So once they have built that wealth up, chances are they're seriously working to diversify because especially once you get in that life cycle, you're trying to maintain rather than explode, generally speaking. So one of the best ways to be diversified in real estate is, kind of this balance between active and passive. Talk a little bit about the difference between the two and give us your perspective on the active versus passive structure.
So I think, that also starts off with time. Obviously, if you're an active investor, you're going to be someone that is in control of all the decision making. You get 100% of the benefit of that. You also get 100% of the liability of that. And you're in control of everything. And some people, that's extremely important to them. When you're investing in real estate passively, which is you're investing in someone else's real estate, either deal or syndication or whatever the project is, you may be putting in capital, but you may not have any responsibility. And for some people, not having access or control over their money, not having complete control over, the decisions being made, that's something that they can't live a balanced life with. So being active and passive, it kind of comes down to how much time you have. And then also just, what your own personal belief is on, trusting other people with your money. And if that's not something that you could ever do, then passive doesn't really matter. Passive gives you all kinds of benefits because you can invest in real estate through all kinds of projects, which helps to give you diversification. But you have to be able to have a little faith and trust in the people that you're investing with, that they're going to be good stewards of your money.
Right. So give us a few examples of a typical passive investments that you look at or you see on a regular basis.
So currently, I'm invested in a few different passive investments. Number one is real estate loans. I look at that as a pretty passive investment in the sense that if you're dealing with a performing loan, which means a loan that's paying on time, once you buy the loan, then it pretty much runs on cruise control. Issues flare up, but not often, and they're usually not that complicated to fix. We also have been investing in some commercial syndication deals, and what that means is a real estate investor will raise a bunch of private capital, and they'll take on a real estate project. And when that project, the actual structure is a LLC with a bunch of passive investors into it. So in those structures, you're investing into the equity portion of the deal, and there's debt that's put on the deal, and then there's a split in revenue with the operator or the syndicator, the person who's running the deal. And basically, they're allowed to get a percentage of the earnings on your money for doing all the work. And it's usually a fair deal as long as you trust the person that you're making that deal with. So that's another one. If you don't trust them, then things can go sideways and can be very disheartening, because one of the things that you trade for your time is lack of control. And once the deal is funded, there's certainly moments in time where you get to see what's going on, but it's not on a day-to-day basis.
Cool. And then, other than the notes and the syndications, what other structures do you typically see?
So you also see people that will invest in turnkey real estate, and I sometimes wonder really how passive turnkey real estate is. I think it can be, but it's not always. Of the passive real estate types that are out there, turnkey's probably the most active of them. So even if you have a property manager in place, ultimately that stuff funnels down back to you. But usually it doesn't, right? So turnkey real estate is certainly something, and also multifamily. Some people that are investing in different types of multifamily structures, if they have the right management team in place, that can be fairly passive, where you're maybe managing more on financial statements versus day-to-day tenant issues. So that could also count as a passive type of investment.
Okay, cool. And then, so you mentioned earlier the notes. I think that's a great example of a really straightforward passive investment. Essentially, you're playing the role of the bank in these circumstances where the homeowner is paying you, the note investor, the monthly mortgage. But not all notes are created the same, obviously. So when you're looking to build an investment portfolio, what are some of the things you look at when purchasing a note?
So the first thing you want to know if it's a performing note or a non-performing note, because clearly how you buy it's much different, from there. Then you're also looking at whether it's a first trust deed or a junior position, a second, a third, could be even lower than that. So you have to have a good vision of what you're trying to accomplish with the note. If you're looking for cash flow, buying performing first are probably the safest way to do that. And the safer the note is, the least yield you'll get back on that note. So obviously banks lend money for first mortgages for, right now in the high 4s, 5%. Private money notes, you can probably get, somewhere between 8 and 10%. So one of the things that you want to have a feel for when you're buying notes is making sure you're getting the appropriate amount of yield for the appropriate amount of risk that you're taking on. And your due diligence process is trying to determine, where the note is vulnerable, and every note is vulnerable, but making sure that the reward you're getting for that is appropriate for the amount of risk that you're taking.
Okay. And do you prefer investing in owner-occupied notes or commercial notes?
It depends on the investor. Are you asking me, or are we talking about within the role of a portfolio?
Yeah, so I guess your answer then is that both are legitimate and both are interesting. It's just a matter of what you're trying to accomplish with the given portfolio.
I even say every investment could be legitimate. Not every investment. There's bad stuff out there, but an investment that doesn't look right to you might be perfectly right for someone else because they have a different set of goals. And I think when you talk about a portfolio, that's the thing that you clearly have to have identified is what is the goal of the portfolio? What is it trying to accomplish? Maybe you have to take on some higher risk stuff to make the portfolio perform the way you want it to. Notes are a great example. Notes offer different ways and can perform in a portfolio very differently. Some notes are really good at giving up cash flow. If you want to create, maybe some appreciation, you can buy non-performing notes. Non-performing notes are like buying houses that need to be fixed up, but instead of fixing up the property and reselling it, you fix up the note and resell it. And it's, it's got its own complications, but it's not as intense as having to, tear everything down to the studs and put it in your kitchen.
Right. So one of the interesting thing about notes is that they're usually, or sometimes they have an amortization function. So talk a little bit about the difference between amortized and amortized notes, or amortized and non-amortized investments overall.
So from a non-amortized perspective, type of note, generally that's like an interest-only kind of loan. That means that over time, whoever's lending you the money, all they're collecting is the interest. But if they lent you $100,000 on day one, when the note is done, you still owe $100,000. Versus in an amortized note situation, over time, there's a balance for every payment that's made that goes to interest and principal. And over time, when you have a mortgage or any type of amortized loan, the more payments you make, the less money you have to pay back over a period of time. Amortized notes tend to be a little safer, right? So for some investors that are craving that kind of return, they'll generally provide a lower yield but more safety. And some stuff that's that is interest only, a lot of times that's private money, and sometimes that money is a little riskier, but it also has a higher yield. And so as long as the risk you feel is calculated, it's worth taking that risk for the higher yield.
Yeah, it's a good point. In fact, I invested in a note quite some time ago, I think 2011. It paid itself down in only 7 years. So the interest rate was about 8%, but the cash on cash was about 18.5%. Now, the reason for this is that the note was paying itself down, and each year is paying a lot of your own money back. But you're getting these large payments about every single month. It's decreasing your risk because you have less and less invested as the note continues to perform. So it's an interesting tool. Another one of the reasons it's interesting is that when they're privately held, you can kind of basically cut them up and sell them however you want. You can slice and dice them. So do you have any examples of how, being able to utilize this function of notes, which is that you can slice and dice the payments up, kind of helped you, or can you give an example of how this may work?
Well, I think one of the classic examples is that, and again, this is a great function of non-performing notes as well, is if you can get a note to reperform, when you go to sell it, you don't necessarily have to sell all of the notes. You can sell series of payments, you can sell percentages of the note. It's an asset that you can divide and sell in pieces, and usually you can charge a higher amount for the piece that you pull off because it's a smaller piece, right? So besides getting the yield on whatever you keep, you get to keep a little bit of yield on money that you've already returned and maybe return with a profit. So there's a great functionality of a way of playing with notes to carve them up to create a higher yield.
Mm-hmm. That's a good point. I were kind of preparing for this. I was reminded of this time that we were looking at selling a note, and let's say the note value was $100,000, but the buyer only had $82,000. Now, typically, if you're buying real estate, you're like, well, that's pretty much the end of the deal. I mean, you can't reach the purchase price. But with a note, we can say, how about this? We will sell you the first 78 payments, and on the second half of the note, those payments will go directly to us. We sell you that right now for the $82,000 you have. And that way, in 10 years or so, whatever, depending on the agreement, all of a sudden you get payments start coming to your bank account. So it's very interesting. And you're also able to sell the note immediately. So When it comes to syndications, obviously we've talked about syndications many times in the show, so I don't want to talk about syndications in general too much. But as it relates to building a diverse portfolio, let's talk about some of the key takeaways for this investment structure, because there's so many benefits from the syndicated structure.
Well, one of the big benefits of syndications over notes is that you get tax benefits, right? So when you do invest in a syndication, you're actually owning a fractional piece of a real piece of property. So you also get a fractional benefit on whatever tax savings there are. So that's one thing about syndications that notes don't provide. And some people like investing for. Some people, that's the main reason they invest, is because they're trying to create tax write-offs to offset income, and syndications do that really well. Syndications also give you the ability to diversify, right? Because most of the syndication deals, you put in a smaller amount of capital than if you were going to buy that whole building on your own. So if you did have, $1 million, maybe instead of buying into one deal that you owned, you might be able to invest in, maybe up to, 20 or 30 deals that other people are responsible for. So you're diversified across a lot of different segments, and diversity is one of the things that syndication does really well. Beyond diversifying in different kinds of assets, you can also diversify your geography. You can have them invested in different parts of the country. I always give an example of, I'm from Louisiana, and I've got family members that owned a bunch of property in New Orleans. And when Katrina hit, their tenant base disappeared by 50% in one day. And it took years to build that back up. And some people still haven't. So having diversity in your portfolio from a location standpoint can also be very important. And because you can get involved into more deals through the syndication, it allows you to create this greater amount of diversity within your portfolio.
Got it. Are there any major drawbacks into investing in syndications that you can see, or what's things you should caution investors when looking at these type of structures?
Well, when you're looking at syndications, the first thing is that you have to understand the people that you're investing with are almost more important than the deal you're investing in. So upfront in a syndication, it's very labor intensive because you're really validating two aspects of the deal, and you need to make sure the people that you're looking at investing with are people that you trust, and doing due diligence on them is key. Everything from doing background checks. I think one of the most valuable things you could do is call referrals. And when you get a list of referrals to call, every person that you call, ask them if they know of someone else in the deal that they could refer out. Sometimes you get such good information, not from that first contact, but the second contact can be really valuable. So it's a great way to try to get a sense of what the, for lack of a better term, what the ownership experience is going to be once you make that investment.
And then
simultaneously, yes,
yeah.
Thank you. And I think simultaneously, what happens is then you're also you're doing due diligence on the deal itself. Is it in the right kind of area? Does their strategy make sense? If they're looking at long-term growth in a certain segment, does that seem viable? What kind of research have they done? One of the things that I like about syndication deals is that you're not necessarily doing your own due diligence in the sense of, coming up with all the data. You get a chance to review someone else's, right? So now it's reading through their materials, and not that that's not time consuming, but it's, it gives you a chance to, check their math and check their strategy and see, how that feels to how you believe the market's going to function.
That's a good point. So when looking at building a portfolio and utilizing the syndications, are there any kind of rules of thumb that you look for in terms of geographic location, sponsor location, or sponsor allocation, asset class allocation when you're trying to build a portfolio that's not overly allocated to one specific one of those?
Well, again, it depends on who the person is, right? There's all different kinds of portfolios. So, certain types of syndications, if you have a portfolio for someone and their risk profile allows them to take on more risk, then you might be looking at some syndications that are more value add, right? Maybe there's a heavier component in the deal to improve the building in a rapid fashion, right? So almost like a fix and flip for a commercial project. That type of risk structure, it's riskier because all kinds of things can happen when you're executing that kind of business plan. But once you get the building up and running, there's an exponential amount of return that you can get because you can create rent and create value in a much tighter process. So when you're looking at a portfolio, you can take more risk than that. You could do development, or you could take less risk. You could buy something that's cash flowing and it's a pretty secure investment, and it's just kind of humming along. Your return won't be as great, but your maybe your consistency or your cash flow, if you're investing for cash flow primarily, if that's the role you need in your portfolio, then you want to look at syndicated deals that may have a greater chance at producing cash flow at a much earlier phase in the ownership structure.
Got it. And when it comes to syndications, what are some of the asset classes you're seeing a lot of opportunity in right now?
We're seeing a lot of opportunity in mobile home park space, and I think equally self-storage. And when we talk about those asset classes as being recession resistant, recession resilient, not resistant. Nothing is recession resistant. There's always a recession. But our feeling is that if we are going to have some kind of correction in our economy, we would rather be in asset classes that we feel will have a better chance of surviving, certainly thriving at times. When something like that happens, people generally move into low-income housing, and mobile home parks offer a cleaner alternative to living in an apartment building. So mobile home parks tend to, not suffer during a recession. And if you lose your home, you've got to put your stuff somewhere, especially if you're combining households or moving in with your parents. So self-storage equally seems to have a bit of a bump in demand, even though other segments of the real estate market might be suffering. We've also invested in some oil deals recently and these were all syndications where, we were buying the oil rights on a certain parcel of land in Texas and Oklahoma and different parts of the Permian Basin. And at the time when we were buying that stuff, we felt that the price of oil was at a point where we were kind of buying at the bottom. And I think oil has certainly not skyrocketed like it did 10 years ago, but it's certainly showing some improvement from where it was just a year ago.
Okay, cool. And where does the typical joint venture structure kind of fall in this? I mean, obviously, that's not going to be as passive as a syndication, but what do you typically see when you see joint ventures? How does this kind of fall in line in terms of portfolio building?
Joint ventures actually can become more passive. It depends on how your joint venture agreement is written, right? So there are ways that you can be very, very passive in a joint venture agreement and put on all the responsibility into one party. Actually, a joint venture is almost like a little mini syndication, right? It's kind of the same concept, but maybe instead of you partnering with a bunch of investors, it's just your money partnering with the operator. And some of those situations, the money partner may want to have a little more responsibility and not give up as much of the revenue. So the joint ventures offer a really nice balance. You can structure it in a way where once you have an idea of how much time you have and how much money you have, it might allow you to enter into an agreement that that's very valuable and beneficial for both parties.
And what type of investments do you typically see make the most sense for like a typical joint venture structure?
Usually single family. I mean, that's most of what I've seen. We've got some clients that have invested in multiple kinds of joint venture deals. What I kind of like about joint venture is instead of having, and we talked about this earlier, turnkey rentals are kind of passive, right? Usually passive. One of the aspects of that is having exposure to the tenant, right? And even if you have a property management company, if there's an issue that the tenant created, 9 times out of 10, or maybe 8 times out of 10, that's an issue that's just going to instantly be turned around and you're going to have to make a decision on. So now you're involved. Usually if you're in a joint venture, you can kind of take that responsibility off your plate and give it back to whoever the person you're joint venturing with, right? So you may give him a little higher share of the profit, but you get back a bigger chunk of time. And if that's how your portfolio is, you're trying to structure it, the good thing about joint ventures is that you can kind of move that bar up and down based on whatever your goals are.
Got it. And so I guess the typical example of a joint venture would be, one person comes up with the money, the other person comes up with the skills and the resources. And obviously you can those are flexible. And because of that, the fees and the structures, the promote, et cetera, those are going to be flexible based on what each party is bringing. For example, if one person is bringing all the money and the other person doesn't have a lot of experience, the person with all the money is going to have more favorable split. But then if there's someone that's bringing all the money and the other person has 10 years of experience, obviously the split's going to be much more favorable for the person that is more experienced comparatively. So just generally speaking, when you see joint ventures for single family purchases, do you see both parties taking out credit or liability risk? I mean, generally?
Taking out credit, you mean like getting a loan on the project?
Yeah. Are they both typically on the loan, or is it just one of them, or how does that typically work?
Well, typically it's just the joint venture partner who's on the loan. So if I'm a source of capital and I'm not active in the deal, because as you mentioned, there are all kinds of situations where you've got all kinds of time or you've got all kinds of money, and both are valuable in a joint venture agreement. But if I'm the capital, and generally there will be some kind of loan on the property, it doesn't necessarily make me susceptible to that loan if I'm not in charge of any day-to-day, decision making on the project.
Got it. That's a really important piece. At least you certainly don't want to be responsible for the loan if you're not responsible for any decision-making skills. I mean, that would not put you in a position of control for sure. So you wouldn't want to put yourself
Absolutely.
in that position. So you did mention turnkey rentals. I think most of the listener base is fairly familiar with the structure, but generally speaking, what are some of the key takeaways that you suggest investors consider when pursuing this structure?
So again, I will cap all of this in depends on your portfolio. However, I think some key pieces of advice that I like to give is that if you're investing in lower quality turnkey rentals, so let's say Class C, things that rent for maybe $700 or less, right? That type of individual structure, it comes with a lot of risk. And I don't always see that the return on that risk warrants the amount of risk that you take. It's almost the same price to renovate a $50,000 home as it is to rent or to renovate a $150,000 home. But in the $150,000 home, maybe I'm getting $1,100, $1,200 a month in rent, and that amount of capital makes my renovation costs a lower percent of my overall operating costs, which can make me more profitable. Plus, people that, and for me, my rule of thumb is that I always think if you're going to own something that rents for at least $1,000 or more. If you're just going to own one or maybe 2 or 3 units, if you keep the rents higher beyond somewhat eliminating that high percent of your operating expenses, what it also does is gives you a better quality tenant. Those people tend to stay a little bit longer. If they're more professional and less migratory as far as their jobs, if they have kids, things like that tend to root people down into a home for longer periods of time. Versus if you're going to own lower class stuff, those people tend to move wherever they get a job. And if all of a sudden they were working on this side of town, they lost that job and they got a job on another side of town, usually they're more likely to move, especially if they don't have kids, because they're not pulling kids out of school districts and all these other life decisions. So I always recommend to people that if you do want to own lower quality stuff, own it in quantity. Right? Because it's almost like buying non-performing notes. If you've got something that's really risky, as long as you own enough of them, you can take that risk and you can spread it out over hopefully a larger pool of assets. So, if you're just going to own one or two, buy something that's a little nicer and make sure that you've got a better quality tenant inside of it. If you want that lower, less expensive turnkey type of stuff, even if you've got someone else managing it, make sure that you have enough to buy something in bulk. Maybe buying a 20-unit building that rents for, $400 to $600 a room. Well, now, even if you do have some drama and some expense with a few of your tenants, you've still got enough revenue coming in to help cover those expenses.
Yeah, it's a really good point. And this is something that I've mentioned before on the show, which is that those lower tier properties, they look good on paper, but if you look at anything besides the ROI, look at the gross dollars perspective, things start to change significantly. So let's say, for example, that a property is renting for $700 a month. Let's say 50% of that's going to expenses, which is pretty reasonable given that price range. So now you're looking at about $3,000 a year in cash flow. If something goes wrong with the property, whether it be a maintenance issue or an air conditioning unit or someone's done damage to the property, your cash flow for the year can be eliminated quickly. And furthermore, you have to travel to the property even once your cash flow for the year can be eliminated. So I agree completely. The tenant base is important. Also, the management companies that you're dealing with when you're in the $1,000 per month plus range are usually more sophisticated. And then, just to add to that, I would say that there's a lot of people out there that started in real estate, made the mistake of buying properties that were $40,000, and now they're investing in really high quality syndications. There's not a lot of people that start in syndications and end up buying $40,000 properties. So that's kind of my takeaway on that one. We have
and Hunter, just one quick thing to add on there, because I think you mentioned something really key, which is about picking the right property management company. Much like we talked about doing due diligence on a syndicator, that is absolutely important when you're investing in turnkey, because again, usually turnkey is out of state, so there's travel costs associated with it. So the same way that I would recommend someone treat the relationship of investing passively in a syndication is exactly the same way I would say on a turnkey operation. The person, once you buy the deal, once you close escrow and you now own it, now it's whoever's managing it you're going to have your relationship with over a period of time. So make sure you're comfortable with those people.
Cool. So we have kind of gone through most of the passive structures, the most typical passive structures that are out there. Obviously, active real estate is a huge thing. I mean, you're an active real estate investor, and you're also an active real estate agent. So when it comes to active real estate, what does this typically entail? What are some of the structures you usually see?
So all the stuff that we talked about when we just talked about, right? When we talked about syndicators and joint venture partners, those people are active investors, right? They're on day-to-day managing projects, making decisions, sometimes with just their own money, sometimes on the benefit of their investors, and sometimes both. Actually, it should be both. If you're investing in a syndication, you should always make sure your partner has some of their own money invested in the deal. We typically like to see at least 5%, maybe 10% if it's a smaller project. So that's important. Active. So anything can be active if you're responsible for it. Most people that are active investors, they like doing development, building, fixing and flipping. I certainly started my career as an active investor. I didn't have a job. That was my job, was fixing and flipping houses. And, we had a lot of fun doing that. We still do. We do it differently now because we've learned a lot more, and we've learned to do a better job of leveraging people, leveraging money. But that's a very active style of investment. Sometimes there's a lot of people that like to manage their own property. If you're taking on any property management whatsoever, it is active, and it is very active, and you have to have all kinds of time allocated. And sometimes you have to have very uncomfortable time allocated, like being on a family vacation or being involved in a family crisis, right? The tenants don't care what's happening in your life. So you're just going to have to be aware that sometimes they're going to inconvenience you, and you're going to have to be okay with that. So that's a very active investment, is owning real estate that you're actively managing. We see a lot of, there are active hard money lenders, right? People that are lending money out to people that want to do fix and flips or buy real estate. The process of vetting deals and doing due diligence and underwriting a loan, that's a lot of work. And those people are, there's a lot of people out there that like lending their money, lending other people's money. And that's a very active role in real estate. Pretty much anything that you're going to spend time on Monday through Friday from like 9 to 5, if it's real estate related, you're doing active real estate.
Right. That's a good point. And even things that you think can be exclusively passive, if you do them enough, they are active. Like, for example, Jeremy Roll was on the show recently, who considers himself a full-time passive investor. And, it sounds like it can't be true. And you look at his schedule, it's like, wow, all this guy does is review deals, conduct due diligence, analyze sponsors, curate investments, et cetera, et cetera. And of course, they're passive investments, but it's something that suits his personality. And so that's kind of how he's done it. So, what are something to keep in mind? Go ahead.
For a guy that is completely passive, he's one of the busiest people I know, and he will never ever tell you that he has a passive life. He's constantly spending time on his real estate portfolio. So, absolutely, and he also, with his Roll Investment Group, there's some active time he spends there as well. So Jeremy's a classic example of, at a certain point in time, if you have enough money invested and you take on enough responsibility, even stuff that should be very passive can become active over a period of time.
And when it comes to, something to keep in mind when it comes to allocating your time, capital, energy, et cetera, towards active real estate, anything to keep in mind during that process when you're trying to plan your financial future as well as your well-being?
Well, actually, one thing I will say about active, and again, planning for your financial well-being, again, trying to put this back into the context of a portfolio, and also the question you asked earlier about building wealth, right, versus preserving wealth and being hyper-focused. That's also something that active real estate development, you can make much larger returns on your personal capital if you're active in making decisions on behalf of other people, because then you also start to make a return on their money. And while you're maybe only making a small return on their money, hopefully, some of these deals, a developer may make 50% of the earnings on the other person's money if there's enough experience in whoever the operator is or the developer is. Sometimes it might only be 20% if you're syndicating a fund, but you might be able to have more investors in the deal. So from a building wealth standpoint, long term, that's one of the main advantages of people that like to be more active, is that it allows them to create leverage off of other people's money and sometimes other people's time. Versus when you're passive, it's the other way around. Your money is being leveraged. You're paying someone the responsibility, taking on, all the decision making and the majority of the risk.
Right. Okay. Well, in terms of, general suggestions or advice you have when investors are creating a portfolio, you mentioned about number one, gut check. First of all, what are you trying to accomplish? Who are you as an individual? What are some things you can add to that in terms of general recommendations when someone's getting started or even veterans that have been doing this for quite some time?
To me, it all starts with self-reflection, right? Having a clear understanding with yourself on what your money is meant to accomplish. If you're younger and you're building a portfolio that's all about creating wealth long-term, you're probably going to take on more risk. Maybe you have time as well as money, so you can also take on some active risk. So that may steer you into looking into projects where you can have more control and leverage up other people's money. You may need a lot of tax benefit, right? So if that's what you're looking for, because maybe you make a lot of money in your W-2 job and you don't really have a lot of deductions, then real estate offers a way to help, create some serious tax advantages. And people that have that need in real estate, they look towards investments that offer, larger tax benefits. If you're older, you may care less about the long-term growth of your money. You may care more about the preservation of your money and the long-term cash flow of your money. So if that's the case, you're going to be building a portfolio that's focused on taking less risk and generating a more consistent, steady return. You may not need to make 10% when you're 62 years old because you've got enough money where you could live comfortably on 8%. So if that's all you need, don't take on additional risk if that's all if you're just looking to preserve your capital base. There's another 100 scenarios, Hunter, where different people are going to have different needs that's going to shape how their portfolio should be structured and what types of deals they should be looking at. But until they have a clear understanding of exactly what their goals are, every investment is right for someone and every investment's wrong for someone else. So you need to make sure your lens that you're looking at these deals, before you even spend time doing due diligence on an operator or doing due diligence on a piece of property, until you do any of that work, if the investment doesn't fit your plan, it's a bad investment because it's not right for you.
Right. So I think that sounds like great advice. I guess the question is, have you followed your own advice? And if so, how's it going so far?
Well, I would say all of us are constantly evolving. My career has become very active, right? So as I've gotten better and more sophisticated and building my real estate career and building my real estate portfolio, I've been able to both acquire a lot of assets, and also I've had the ability and the luxury of being involved in a lot of different kinds of real estate deals. So for me, the success that I measure beyond just the money that I'm earning and building and the wealth for my family, it's also the fact that I actually like this industry. I like the people that I'm dealing with. So the time that I'm investing in this is something that I find extremely valuable and very beneficial. And I've been able to build a career in real estate that's very rewarding. And for me, time is just as valuable as money is.
Awesome. Well, I think that's a great note to end it on. Dave, I really appreciate you coming on here. Obviously, a ton of information about this topic and others. So, we're going to have to keep bringing you on the show to talk about some other stuff. You obviously are involved in multiple different stuff. So again, appreciate the time.
Hunter, thank you very much. And if anyone out there has any questions, if they ever want to talk about, how to build their portfolio, you can reach me at david@realtor.com.
Awesome. We'll keep your contact information in the show notes page so people can contact you directly. And thanks again. For all the listeners out there, don't hesitate to reach out to David. He is an absolutely excellent person to know in the real estate game. He has experience in all different types of transactions. You can reach him directly, like you said, David, David, at corealtor.com. That's COE realtor.com. Don't forget to like, subscribe, and rate us in iTunes. Remember, you're going to get that free ebook. If you do so, just send me the screenshot to hunterthompson@cashflowconnections.com. Thanks a lot.